Well, it looks like I'm live. Haven't done StreamYard in a while. I got a little time. I wanted to play around with a chart that I've been working on. Case Shiller index is kind of takes a composite. Well, this one's the regular Case Shiller index, but I'm comparing it to the M2 money supply. I just want to see if there's a relationship there. The more we print money, it seems like house prices go up. We never really track the correlation. We try to track inflation. We try to, track CPI with housing. The housing affordability index is supposed to kind of show a relationship, but I put the index to match it up with the Case Shiller index. So I put the M2 money supply on an index to line up with Case Shiller and see how that compares. And then Michael Zuber, OneRental at a time, did a 53-year spreadsheet. So I just kind of wanted to see how those line up. There's definitely a correlation. I'll go through that with you now, see if I can figure out how to share my screen, present, share screen. There we go. Okay. So now we've got on the left here, we've got the S&P CoreLogic Case Shiller Index. It's not the composite 20. Then we've got the M2. I index that. So January 2000 equals 100, the same index as CoreLogic Case Shiller. So if we go to 2000 here, January, somewhere in here, January 2000, that equals 100. So we're going to try to track the relationship with M2 money supply. M2 money supply, it is the measure of money supply that includes cash, checking deposits, and other types of deposits that are readily convertible to cash, such as CDs. So it's not a science. I'm just looking for the relationship here. See if we can kind of make some predictions on where house prices are going to go. If we go back to the Case Shiller starts in 1987, so that's kind of where we have to go back to. We will see that the Case Shiller index is higher than the M2. The relationship there is higher than the M2 money supply. And then it kind of levels out. And then it kind of shoots up simultaneously through the 90s into the early 2000s. And then right around April 2003, it drastically departs. Case Shiller shoots way up. The home price index shoots way above the M2 money supply and then comes crashing back down in 2008. So we can see that relationship. We can clearly see the bubble there. So that's kind of what intrigued me by this. And then I'm trying to track what's going on here. It seems like the more we print money, the M2 supply, the house prices just follow, right? The house prices are just following the M2 money supply. And then this is the COVID. We just printed a ton of money, like a 40% increase, and it shoots way up. And then here's kind of where the rates get volatile. You start to see the Case Shiller dip a little bit, and then they kind of rein things in. There's a lot of volatility right here, so it's hard to tell where the future is going to go. I wanted to compare this to, we'll go back to 1987. If we go to the 53-year chart that OneRental at a time put together, we can show the nominal home appreciation and real home appreciation. Oh, geez, come on. There we go. So nominal and real home appreciation. So we're kind of seeing this, and then the housing affordability index. We're going to look at kind of the three of these. So we're looking at this period here from January 1987 to about where it collides here at May 1991. So we've got home price appreciation going up, but then real home price appreciation in 1990 takes a drastic turn and goes down. So that is showing a bubble here because it's gone above. So this comes crashing back down 1991, and it gets back in line. So this lines up with that 53-year chart. So it is showing there is a direct relationship between M2 and the home prices. So Case Shiller lines up, the 53-year chart lines up to show that relationship. Then we kind of go up to here to 2003. I'll move over to the 53-year chart here. And I've got 2003 to 2008. So we diverge in 2003, and then we come back sometime in 2008 where the two cross, they intersect one another. So if we start in 2003, we're showing the home price increases, real home price appreciation 10.87. 2006, right here at the peak. Oh, looks like we hit a bubble and it starts to dip. And then it comes crashing down in 2008. There's a direct relationship there. And then this is where all the doomers are saying, okay, now that this house, the blue line here, we're clearly in a bubble, What they don't show you is that red line of M2 money supply, right? The argument is, well, we have too few homes. We have, so much demand, the population, the demand for housing, lack of housing. But I'm gonna break from that argument and say we just have too much money chasing, the same number of homes or too few homes. So really, the home price is really just a reflection of M2. Now, what is going on here, I don't quite understand yet. This is right at this peak is May 2022, which would be when the interest rates started to spike. I don't have that information in front of me. I wish there were some people on live chat here to get me that information. So I think the interest rates spiked up, which would have probably pulled in the money supply M2, which would have constricted or contracted some of the home prices as less loans were being issued. And then I think they loosened up the rates a little bit. So we shot up again, and we're kind of seeing the M2 get tight here, but we're still seeing the home prices start coming back up. So prediction from here, there's a big spread, historical spread. We only go back to 1987, but that's a huge chasm between home prices and the M2 money supply. If this relationship has to go back to this trend line into the 90s here, then we're going to see a massive run up in home prices, not the other way around. We got to track this to see if this does hold true. But if that relationship is true, then home prices are going to shoot up. It's going to historically, home prices have paced inflation. It's shown in this chart here too, but Case Shiller only goes back to 1987. So my prediction is we're going to see more home price running up, unless what we get is some sort of banking crisis coming out of the commercial real estate market, which we could. That's there's a lot of things that can happen in the world. We're kind of in a volatile environment around the entire globe right now. So, we could have the commercial real estate come crashing down, banks pull in the money, which the M2 could come crashing down. If the banks stopped lending, then maybe we see, that spread get closer. But I think that spread has to be a lot closer between the M2 and the Case Shiller index. So I just wanted to compare that. I'll try to watch this a little more. I did try to pull the percentages to see if we can kind of come up with what that should be. I don't know if there's enough history to show what that relationship should be over time. So we'll just kind of track it from there. If you got any other input on this, I'm kind of new to this. I'm kind of picking apart the numbers here. I don't think anyone's compared this before, and I've been eyeing this for a while, and I didn't really know how to express it. So I thought I'd jump online here and throw that out there for anyone to comment on and see if this is off track, or see if there is that relationship. There sure seems to appear to be a strong relationship, which makes sense, right? The more money in the system, that just goes and chases and bids up the assets. So that's all I got tonight. I look forward to hearing from any input you got on this one. And till next time, I will talk to you later. See if I can figure out how to hang up here. Here we go.